522-7655. So we've got that legal bit out of the way. The other thing, I work in real estate, and I say real estate professional because we do two types. I do auctions, and I also do just your old school traditional stick a sign in the yard, sell the house kind of thing. So we do both. I do both. Pete lends for both. That's even more important. You can get a loan for an auction.
Yep.
That is one of the most misconstrued.
Not everywhere.
Not everywhere, well, there again, it kind of goes back to what I was saying is the whole purpose of this is two things. I want to, one, create authenticity, and what better creates authenticity than being unscripted, because any dingbat can read off a script, right?
Right.
I'm now making you nervous, huh?
A little bit.
Well, anybody can read off of a script. And I just don't see any value in that. I'm going to put us live on Facebook before I get into too deep.
Okay, 12:53. So we're early.
We are early.
But that's good to be early.
It's always good to be early.
As a pilot, I like showing up on time.
10 minutes prior, man.
You show up 5 minutes early, you get shot.
You know me for my 10 minutes prior. Okay, and in sequential order, I'll just go around. We have Facebook Live. Everybody, this is Pete Griffin. If you haven't already met him before,
Everybody.
he is going to be sharing with you some mortgage advice. Again, as a disclaimer, we're not giving out legal advice. We are here to take your questions and give you answers, because I feel like knowledge is power. I feel like a lot of people don't want to get up and really do any of the digging to find out exactly what's going on. Now it's asking us to put a mask on. I don't think we need to do that on here. Maybe they're telling me that I'm ugly. I don't know. Yeah, either way, we want to create some authenticity within the realm of mortgages and in the realm of real estate. A lot of people, they just don't understand what to do. A lot of people will come to a real estate agent first. That's their first mark, is let me go to a real estate agent. And really the first person anyone should go see is you, because you're going to tell them exactly how much money they should or could spend.
That's the best place to start, because somebody can go to you thinking, one thing, that they're in a certain price range, but they're not considering all of their obligations, and maybe they're in a slightly lower price range. Maybe they think, well, I need to be in this price range because that equates to a house payment of, $1,500 a month. And they come to me and I say, actually, you're about $50,000 more house if you're looking at that house payment. So there's so many different programs and everything that are going to vary from one buyer to the next. So yeah, I think a great place to start, one to refine their own goals, and two, see exactly what they're qualified for.
So let me just explain against the multi-platforms of what we've got. First and foremost, over here we have Facebook Live. So if you're on Facebook Live, we can read your comments, like, share, subscribe, send this to whomever you want. Our goal is to be able to answer any and all questions about mortgages, real estate, anything like that, whether you're in Fredericksburg, Virginia, or you're in San Diego, California. We have a fairly expanded network. We've got people joining in on the Facebook Live right now. Obviously, my wife's from Texas, so we've got some Texas people joining in.
Right.
And there's probably people hoping to see.
Half the other people just left, right?
Yeah, they're probably chiming in to see her face, not my ugly mug, but neither here nor there. Any kind of questions you have, we're going to be here to answer those. We're also on Google Hangout. We're on YouTube, and for my YouTube people who are watching, again, let me switch this over so we can get the comments live. If you have any comments, questions, anything at all that you want answered, go ahead and add them. That's what we're here for. We're here to answer those questions. Also, Instagram, my last and newest addition to our thing.
Nice.
Comment, ask questions. If you've got anything you want to know, by all means, ask. What our goal is today is to kind of just touch bases and answer some questions. And if you guys don't have questions, as it is right now,
and I don't have any masks, so
Brian, we will definitely get you some more business cards. That's not a problem. I just spilled all of Pete's business cards all over the place, so I'll get you a set.
Hold it up to the camera.
Take a screenshot and then send this. I'll bring you some cards, Brian. And please tell Ayana I said hello when you see her. If you see her on the train.
I'm too far away to read the Facebook.
I can read them from this far. We're in good shape, my friend.
All right.
So what we're going to do is we're going to basically just round robin some of the questions that people have had in the past.
That you know that I don't. Thank you.
That I know that Pete does it, and that's again, it's not a setup. It's a setup for being authentic. There you go.
So I have to do a disclaimer that. Oh, I got to say my NMLS number again.
Go ahead and say that one more time.
I'll do that, but my disclaimer is I have the right to be wrong today.
Okay.
And get back with you later if I get a small portion of the facts mixed up. So I'm gonna be shooting from the hip for the most part. Hopefully, I'll be able to answer the questions thoroughly, but there may be some things that need a little bit of tweaking.
Yeah, I'm not going to float you out there in the middle of nowhere. So take it away on the NMLS number.
NMLS 1227655. I think
Okay.
that keeps me legal.
That keeps us legal. Also, to keep us legal, let me just say, across the multi-platform spectrum, we're not giving legal advice. I'm not an attorney. Pete's not an attorney.
Yep.
We are many things, but
We're a couple guys chatting on Facebook, YouTube, and Instagram, and everybody's watching.
That's right.
That's the extent of it.
That's pretty much where we're at. So let's just dive right in. I know I'm a little bit early, and there again, that's
You got a minute.
right where I need to be.
So 46s will be in zone here in about
Hey,
30 seconds.
Yeah, exactly, but I'm just going to just let you know, as an Army soldier, we all know 10 minutes prior is what? On time. So that having been said, a quick brief background on Pete and just who he is. Pete has become a really good friend of mine over the past couple of years. He's so good at what he does that I referred my mama to him. That should tell you everything you need to know.
Well, me too.
Yeah.
That's both ways, right?
Yeah, well, true.
Right.
If you can refer your mom and dad to somebody, that should tell you everything you need to know. Pete has been instrumental in seeing many people through the process of saying, okay, I don't think I'm going to get approved for a loan, or I don't think or I was told by this bank I can't get a loan. That's my buddies are joining in. Everyone's chiming in. I'm seeing what's going on.
Yeah.
We're here to answer any questions that you might have. So the main questions that I get, Pete, a lot of times are, I want to buy a house, but I don't know how much I can afford, or I don't have any money in the bank. Pete, what do you think, just to answer that question first and foremost, how much money should a buyer have on hand? And I know it's a loaded question, but just, of the three major loan types, whether it's VA, FHA, or conventional.
Yeah. No, that's a good question, and I'm going to give you what the optimal best down payment to have is.
Go ahead.
The industry will respect you the most if you got 20% down. So you're going to get better interest rates. You're not going to have insurance requirements, and you're going to have more buying power and be more credible if you come to the table with 20% down to a seller. Now that's the starting point to deviate from. Not everybody's they're buying, a $200,000 home. They don't have $40,000 in the pocket to go do a down payment. So that's the best place to be.
Right.
So backing up from there, it really depends on who you are. If you're a veteran, for example, VA is going to treat somebody with 20% down as same way they treat somebody with 0% down for the most part. So you can have 0% down on a VA if you're a veteran and eligible for VA benefits. Another government program is an FHA loan, and it's a subsidized loan by the Federal Housing Administration, and that allows you to bring, generally speaking, only 3.5% down. But there are FHA plus loans for first-time home buyers that lets them bring nothing to the table. Mm-hmm. In the state of Virginia, we have VHDA, Virginia Housing Development Authority. They have some variants of FHA loans that allow them essentially to bring 1% to the table with a grant, with a 2% or a 2.5% grant. And then there's your standard conventional loans, which it's conventional because that's what most people are using. Mm-hmm. Generally speaking, 5% down, but there are cases where we'll do some programs will allow 3% down on conventional loans.
Now, another loan type that a lot of people aren't aware of is that I've come to see. People say, I would love to buy a house, but I don't have any money to put down. And let's be real. In 2017, who's got?
I forget USDA. Is that what you're going?
That's where we're going.
USDA is USDA is are qualified
RD,
buyers,
yeah.
a rural development area. So some people call them RD loans. They're backed by the USDA, U.S. Department of Agriculture, and they're in areas, agricultural areas or rural development areas. But you'd be surprised. I mean, you pretty much got to go 3 miles out the interstate, and you're in a rural area by the USDA maps.
Right.
So USDA loans, there's a lot. As every loan, there's qualification requirements. Generally, USDA, you can't be making a whole lot of money. There's going to be income limits.
Seems like a hard problem to have.
There's going to be income limits for those, and they depend on the family structure and whatnot. The property has to qualify. So there's two parts of every qualification. The buyer or the consumer has to get a credit qualification, and the house has to qualify. And for a USDA, one of the big things about the house qualifying is it has to be in a USDA or a rural development area, and that's 100% finance loan.
Easy enough. So another thing that I've come to realize is each of those loan brackets, they can have variances in credit requirements.
Right.
So I got people that call me all the time like, dude, I got great credit and everything's all good to go. My credit's awesome, and we find out that they couldn't finance a ham sandwich from a street cart vendor if they wanted to.
Everybody can finance it, just win.
Right.
So everybody can get to a point where they can finance. They just might not be today.
Okay.
And so a lot of lenders look at it. You're not qualified. Sorry, take a hike. I don't look at it that way. I look at
I know
it
you
like
don't.
You're not qualified today. You're not qualified today. You take these steps, you'll be qualified in 2 weeks, 6 weeks, 6 months, 5 years. So,
and I think this is important. The credit score you get from the guys like singing and playing guitar in the car and stuff like that, annualcreditreport.com, I think, or whatever, free credit, whatever. The stuff that you're getting from those people, I think it's also valid to say that that's a totally different credit that's a credit score that doesn't necessarily translate over to...
Nope. No, there's different. I don't know how many there are. This is one of the things I'd have to look at.
FICO 1, FICO 9.
Yeah, I think there's FICO 1, 2, 3, 4, 6, 7. I don't know.
We know that there's at least 2.
There's a bunch, and I know that for mortgages we use the oldest one. It's FICO 1,
right?
And it looks more. It looks at things like installment debt. It looks at mortgage history. So it highlights things that are important to the mortgage industry.
Okay.
And so if you got some other credit monitoring service, they're probably looking at your standard consumer credit, like for buying a car, getting a credit card, opening up a department store card. Mm-hmm. Completely different market than the mortgage industry. And so that score is going to be different, probably 100% of the time, from what you get when you do a mortgage credit.
Right. So when someone says, "Hey, I'd like to get a home, but my credit is shot," well, let me redact some of that. If somebody calls me and says, "I'd like to buy a home, but my credit's shot," chances are their credit is shot. Pretty much they know that. Right. But if they say, "I'm not sure, I may get one," I think the smartest thing to do is do the app. And I think it's also valid to say that with the credit application that they're doing with you, everyone says, "What? I don't want to run my credit because you're going to hit it and my credit score is going to go down." So what is the difference in the credit that you run versus what they think?
All right. I want to answer that, but I left something hanging on the last point. The last point we were talking about, somebody says their credit is horrible. They just think it is, or they assume it is. It may not be. It's good to do an app. If you ever want to buy a house, call me, do an application. We'll figure out where you're at. So if your credit is low, let's say your credit's 480. That's a low credit score. Let's say it's 520. It's still below the point where you can buy a house. Generally, you got to be above 580 to purchase a home.
That's not really hard to do.
Right. Wherever you're at today, though, we can figure out how to get you to a score where you qualify for a loan. So that's what I was saying. There's not a score that's too low to buy a house. It's just when you're going to buy the house. And then it's up to you to take the steps necessary to get to the point where your credit score is. So it falls in the buyer's court. It's not in the lender's court. It's not in your court. Mm-hmm. If they're motivated and they want to buy a home, they can buy a home. I used to, when I was a flight instructor down in Pensacola, I used to tell folks, I can teach anybody how to fly a plane. It's just a matter of how long it's going to take.
Right.
And, if in that environment, there's limits to that. You can only, somebody doesn't have them, they can't pick it up in a few months. You're probably not going to be a pilot, right? Well, for buying a house, you set the time limit. It may take you 2 weeks, it may take you 6 months, it may take you 5 years to get where you need to be credit-wise to buy it. But everybody, I think, in the United States of America can buy a home. It's the American dream, and I think it's there. So your next question was, what were you asking about? You were asking, so it was related to credit. Where are we going?
No, I had said the hit on your credit.
Oh, the hit. So yeah, so here's how that works. If you do a lot of credit inquiries, that may indicate that you're in a stressful situation. So it might not. Like, so say you want to go open all of a sudden 10 credit cards. The industry is going to see that and say, something's changed for this person. They're a higher credit risk because they're opening all this credit all of a sudden. Some emergency must have happened. They got a big medical bill. They're going broke. They want to avoid bankruptcy, whatever.
Right.
So you can go apply for 10 credit cards and maybe even get them at the same time. But the industry protects that a little bit by lowering your credit score if you have a lot of credit requirements. Mortgages are completely different because the industry recognizes that you're not going to go buy 8 houses tomorrow.
Right.
I mean, for most people, it takes 30 days to buy a house.
Correct.
Obviously, we have a much shorter processing time and movement. I've closed loans in 8 days, 12 days.
Sure.
It's not obviously the ideal way to do it. 30 days is generally what it takes to buy a mortgage. But the industry recognizes that you're not going to go buy 5 houses in a month. And so if you have up to 4 credit pulls in a month, that's the equivalent of a single pull. So you could get 4 different mortgage companies, and you should shop. You could get 4 different mortgage companies to pull your credit in January, and then 4 more in February, and 4 more in March. And not that I don't know anybody that would do that, but it would have 0 to very minimal impact on your credit scores. Not the same as a general pull from a car dealer, department store, or a Visa card.
Sure. So for anyone who's just chiming in now or just joining now, let me just kind of go over what we're doing. Again, it's the Confessions of a Real Estate Professional. And a lot of this is we just want to add some content that would be valuable, that would provide some insight on some things you might not be aware of, programs that might be out, things that might be coming on board that you might not know about. I'm with Pete Griffin from Movement Mortgage. And again, if you rewind all the way back to the front of the video, you'll hear his license number and all that. And again, we just want to add some kind of value to today's marketplace. As I said earlier, the name of the video is Confessions of a Real Estate Professional. And really, well, we both are.
I guess we are. Yeah.
You're a real estate guy too. You just work in a different avenue.
Yeah.
And I want to continue this series with other people, whether they're home builders or, whether they're auctioneers. We're going to have John Nichols from Nichols Auction Marketing Group, also the president of NAA until July. He's going to come on here and talk about the auction method for purchasing homes and some other things. And our ultimate goal is whether you buy a house with me or you don't buy a house with me, whether you get a loan from Pete or you don't get a loan from Pete, the real value that we want to add on any front is that we are providing you relevant information and really just providing you the basis of knowledge. All being said, we'd love an opportunity to have your business or earn that business. It's probably a better way to say it.
But we're in the business to value people and assist them in their and their mortgage needs and their home buying needs or their auction needs. And that's why you and I, started working together early on. We found out we got the same passion. The passion's for the people. It's for the individual and their needs. And we know that, the paycheck's going to come if we do that the right way.
Absolutely. I mean, and I think, and I said this before, and I think that this probably translates well for both sides. Mm-hmm. I don't view it as a sales industry. I don't think you really view it as that. It's more of a service industry.
Exactly.
And the value that we're trying to tie in is putting you, the buyer, or sometimes you, the seller, in the right position. So we talked a little bit about credit and stuff. Pete, let's go over, and this I want to be a Pete Griffin answer. I know what the industry does as a whole, but I want what does Pete Griffin do? Let's say that my credit's just not tapping the score that it needs to be. What then are you going to do as Pete Griffin, the lender with Movement Mortgage? What are you going to do to ensure that person does, in fact, make the move towards the closing table and can get the help they need?
So the first thing to do is to find out why the credit score is there. And it could be a lot of different things. It could be a past foreclosure, short sale. It could be missed payments on a debt. It could be a contested issue that maybe the consumer isn't really at fault and it's a misunderstanding that has to get resolved.
And that does happen.
It does happen. We're going to find out why, and we're going to come up with a plan to get that score to where it needs to be. I'm gonna have a conversation with the buyer, say, look, this is where your credit is. Here's a copy of your credit report. We use Credit Plus, and so it comes with a service to where you can go on there and explore different ways to increase your score. I can do Credit Wizards and print out, hey, you got $2,000 of money in savings. Mm-hmm. If you apply that $2,000 this way, this program will spit out. It's going to make your credit score go up by 15 points, 20 points, 30 points.
So some ultimate value just off the cuff, whether they get that loan or not. And so make sure I got this correct. They submit an application to you. Moving Mortgage is then going to help them get that credit where it needs to be. If they don't, like they did it today, I don't qualify today. You're going to say, hey, you didn't qualify right now. Here's what Credit Plus is saying you need to do.
Right. Okay. So the only person that can help their credit get better is themselves.
Sure.
So the individual has to be motivated. So if somebody's motivated and they demonstrate, by their actions that they're going to take the steps necessary to improve their credit to the point that they are being advised, we're going to give them the advice. If I give somebody advice and they don't do anything with it, and they come back 6 weeks later and nothing's done, I'll give them the same advice again. But their score's not going to go up just by getting advice. You got to do it. You got to hear the advice, take it, and do this, and take the steps to improve your score.
So that's actually, I really like that. I think that there is a level of ownership that people got to take for themselves to say, I got myself in here, I need to get out of it. But what you're telling me is they don't have to get out of it alone. So
most people that keep low credit scores, they choose. That's a choice.
Sure.
They choose the
Sure. I agree. We've kind of hit the credit thing, on the head. And again, let me just say cross-platform. If you are watching the video, like it, share it, subscribe it. We want to answer any questions you have. The text box is open. You can ask questions now, and anything you ask, we will answer right on the spot.
Right. Can I use the word keep?
Yes.
People that keep a low credit score is their choice. There may not have been things that they did directly. It might have been circumstances beyond their control that got them to a low credit score. But you don't have to stay there.
Mm-hmm.
It's your choice whether or not you're going to take the steps necessary to get a better score. So
that is
so you can blame
definitely fair.
And it may be legitimate blame to say I have a low credit score because of X, Y, and Z, and that may be 100% true.
Sure. But
you don't have to stay there, and so that's good news. You don't have to. You don't have to remain in that place that you're at. You can get a better score.
Absolutely. On that end, I think that's a really key element. A lot of the questions I get, Pete, are people who want to sell their home, and most realtors will tell you. In fact, I'm not the only person that sells real estate in Fredericksburg, but most people will tell you as a general rule of thumb, when you factor in the sale of a property, you need to factor in your closing cost, most likely the buyer's closing costs because they're going to ask for that subsidy, repairs, escrow, things of that nature. So I typically tell people that if you don't have 10% in equity in your property, it's really a useless decision to try to sell your property because you're going to come out of pocket. Now that 10% equity, that all being said, and this I think is valid, and it's really something that people need to pay attention to. That 10% doesn't make you any money. It just helps you transfer the property out of your name into somebody else's.
Right. Home's a commodity. A lot of people forget that. If you look at it if you're into investing or buying stocks or mutual funds, it's just like that. It's just you can't trade it as quickly. You go to stock exchange, you can trade it, 8 times in a day,
absolutely,
100 times in a day. So you can make a choice to have something that you're upside down in. In other words, you owe more than it's worth after you take away the cost to sell it. So there's people that decide to sell their home, whether circumstances they have to move or whatever, or they approach it as, this is an investment. I've taken a loss on it. I know I'm going to have to come to the table with, $2,000, $5,000 to sell the property because my goals are to move to a bigger home or to a different home or a different location. So I would agree 100% with what you said and just say that there are people that will sell a house and take a loss because of circumstances or their desire. It's just like a commodity. They're going to sell a house, take a loss on it, and they're going to transfer their investment somewhere else and pick up where they left off.
So a question I also get all the time, and this is rampant in the real estate market or industry. Again, I believe in the whole mindset and the mantra of we need to value people more than we do a sale or a deal, because sales and deals, there is always somebody buying a house. There's always somebody selling a house. That's all fine and well. But I think one of the other things is like a deal that we just had not too long ago, where we sat down with the person and they said, I got to sell my house. Well, why do you need to sell the house? Oh, well, I got to sell the house because I can't afford it. Well, why can't you afford it? Let me see your mortgage. And we start looking at it, and what we come to find out is they can't afford it because their interest rate is like 7% or some crazy stuff like that. So on that term, I guess the question is best posed this way. What percentage, if people don't know, so there are people who don't know what their interest rate is. I know what mine is. I'm sure Pete knows what his is. If you don't know what your interest rate is, it's a simple phone call to the bank or logging on, and you can just find out, okay, well, my interest rate is 5% or 1%, but it ain't 1%. The lowest it'll be is, what, 3.25%?
Well, it depends. There's times where you could have bought below 3.25%, or if you had a 15-year loan, you could be on that's a standard 30-year loan. The lowest most people find is 3.25%. But I mean, 2 months ago, I did a couple loans at 3.0.
Right. So there again, like you might say, well, you know what? I don't have enough equity. I can't afford this house, so I got to sell it. Well, the answer might not be sell the house. The answer might be refinance, because what you got the interest rate at before, and I think from our little meeting earlier today, there's two major factors that drive your interest rate. Number one is the federal reserve, and the other is your credit score, right? Yeah. So if you were at a 620 and you squeaked in and you got set up to where you could actually get a mortgage, and now your credit, you've had the loan for a year and a half or 2 years, and you got it at 5% interest, and your credit's gone from 620 to 720, then there's a good chance.
Even though the interest rates have gone up since early November, there's still plenty of people that could benefit from a refinance. So there is a point where you benefit from the refinance regardless of what your goals are, because you're paying too much money, you're paying too much interest for the mortgage that you have. So in other words, you could keep paying the same payment that you're paying today every month, refinance, not pay any closing costs, and pay less and pay that same amount, and you'll pay your mortgage off earlier. That's the easiest way to look at it. It's a no kidding immediate benefit for you to refinance your home. So if somebody's today at, let's say, 6%, and they refinance at no closing cost, let's just throw a number out, 4.5%, they're gonna more than likely, if they keep paying that same amount, they're gonna pay their mortgage off sooner. Mm-hmm. Most people don't want to do that. Most people want to lower the payment. But that's a way that it's easy to explain. You benefit today from refinancing. It just makes sense because the numbers make sense to refinance today. Now, if your goal is to lower your payment, maybe to get a little bit of cash out of equity, so there's no perfect answer on whether it's right or wrong to refinance. There's times where you can't refinance. Yeah. But if your goals are, I have $50,000 equity in my home. I'm currently at 4.25%. I'd refinance at 4.25%, but I'm gonna pull some equity on my house. Maybe that best meets your needs at the time. So it might not necessarily mean for every single person that they got to have a 0.25% reduction in their interest rate or a 0.5% reduction in interest rate. Fair. It depends what their goals are.
And I think that there is a perfect answer, and the perfect answer is don't assume anything.
Right.
We've already touched on the credit side. So applying for a mortgage or contacting you for refinancing, that doesn't cost them a dime. Yeah. Putting the application in online, which is on your website, which I'll link to later, that doesn't cost them a dime. That doesn't really cost them a credit hit. It doesn't cost them anything to just say, you know what, Pete, I'm shopping the market. I don't really know what's out there, but I'd like to find out what can I do to, lower my monthly bills or get cash out, or, am I in a good enough position to sell this property, or, all those things. I think the answer is, pick up the phone and make the call, get on the computer and send the email, do something, because, and I want to go back to what you said earlier about the comment, and I think it's true of you don't have to keep your bad credit score. You don't have to stay in your loan. If your loan is something that's not really benefiting you, the better answer is go see what's out there. It's people tend, I find, they tend to not look at refinancing their home the same way they do as like refinancing a car, which is a depreciating asset. A car depreciates the entire time you own it. I don't know anyone who's bought a car and then made money on it when they sold it. So
an antique or something.
Unless it's that. So taking the number one asset that almost anyone owns, which is your home. I mean, like, if you really think about it, people might dabble in the stock market and they might have saving bonds and CDs and they might have money in this account and that account and all that stuff. That's all fine and well, but we can all agree, I think, the largest asset that any one person has is their real estate.
Yeah.
If you own a home, that is. So why wouldn't you exercise the care and caution to say, hey, you know, is there a way I can make my investment make more money for me? Or is there a way I could pay less money for the investment I already do have?
Right. And that's why it's important to have that conversation. So I answer very few point blank questions like, am I in a good place to refinance? I know that's not enough information. It's not enough information for me to ask, what's your interest rate? I need to know more about you, what your goals are, what your interest rate is, what your current balance is, all the numbers we need it, but more importantly, I got to know who are you, what's your disposition in life, and what are your goals. And after we have a complete conversation, I can present you with options, and then you can pick what to do. So you're not choosing to refinance if you just say, I have a number, can I refinance? That's not a sufficient information. You got to have a conversation. And I know there's some folks out there that may just say, hey, can I refinance? They'll run the numbers and say yes. I'm not going to work it that way, just like you're not going to work it when you're talking about buying a house. And I've known cases where folks have gone to you saying, hey, I want to buy a house. And you've said, no, I think you need to stay where you're at. You're in a good spot.
Well, yeah, absolutely.
And the same thing, there may be somebody comes to me and they say they want to refinance. And I'll go through all the points and I'll say, my personal opinion and professional opinion is you should not refinance.
Stay where you are.
Right, you're in a good spot. You're not going to get that from everybody, I don't think.
Sure. So for those of you who are, again, just joining us now, I'll tell you that we are discussing the benefits and advantages of having a solid mortgage lender. Mr. Pete Griffin from Movement, good friend of mine, and he has just done miracles for people that should consider themselves blessed. But that's neither here nor is it there. If you are logging on and you have any questions about anything, please fire us. I mean, we're here for your disposal. So I have a set of questions that have been asked of me that I am going to be continually asking Pete to generate some conversation. But if you have a question yourself that you'd like to get answers to, I mean, please don't hesitate to throw it in either Facebook Live, YouTube, or Instagram. I mean, we're even on Google Hangout. I mean, we're on a little bit of everything. Pete, another thing. So as you know, I'm an auctioneer. And because I'm an auctioneer, we sell houses as is, where is, no contingencies. And the biggest thing that we hear is, well, I can't buy a house at auction because I can't get a loan. And I think that that's a misnomer. What's the best word I can say? I think it's something people believe, and they believe it about themselves. And whether they know it to be true or not, they just automatically assume, well, it's an auction, I can't afford it. Right. I can't get a loan, I'm not going to be able to buy it. What would be your answer to that?
Well, I'm going to brag a little bit about my company because this is where it does matter a little bit, because Movement Mortgage has an upfront underwriting process. And we also have a 6-day mortgage process that will allow us. That's great song, isn't it?
I was like, you gotta cut that down, dude. What's really going on?
Alexa, she's not listening to me. Alexa, hey, reduce volume by 25%. We got a little less.
Okay, thank you.
Okay, so
Sam, just while you're doing your stuff, I'm gonna be just in the back. Just go ahead. Sorry.
So that wasn't an advertisement for the Echo Dot or anything.
Yeah, definitely not.
But actually, it was. So you guys can send me a check. We were talking about auctions. So the biggest issue, oftentimes with auction, is the auction will have requirements up front for having a approved loan. In other words, coming in with, and I'm going to speak bad about loan officers for a second because I'm one of them. Loan officers are paid by commission usually.
Typically.
We want every loan to close. So our general disposition is to say yes, you qualify, because we want to get paid,
absolutely.
right? I'm being sarcastic, but our disposition is to a sale. An underwriter's disposition is to interpret the law correctly. So Movement Mortgage does upfront underwriting, so we can have somebody that's interested in doing an auction 10 days from now give me everything I need, all the documents, fill out an application today. I can give them an answer whether or not they're underwritten, qualified within a week, usually within a couple days.
So on that, documents, what are some good things for them to just have in hand before they start a process?
All right, so the baseline of things that pretty much every lender is going to need, they're going to need 60 days worth of pay stubs, they're going to need 2 months worth of bank statements, or 2 months worth of statements for whatever assets you're using for the transaction. Copy of who you are, copy of your ID card, 2 years of W-2s. We may or may not need 2 years of taxes, and then consumer credit report that will get you to sign, a few other upfront documents we get you to sign, and then that's the base list. And then if they're a veteran, we'll get some more documents about their service.
Sure.
If they're looking for a government loan, we'll get some more information about different things. So that's kind of the baseline we're going to start with, and then I'm going to look at who you are, what you do, and give you the full list of documents. You get that list of stuff back to me today, tomorrow, by Tuesday or Wednesday at the latest. I'm going to have an answer from our underwriter that you're qualified to go bid on this house at auction for up to $325,000.
Right. And the auction process, I just want to throw it out there. The auction process, we are going to have John Nichols on board with us, giving you some of the breakdown. So you want to think about selling your property at auction, we'll explain that to you. If you want to think about being a buyer at an auction, explain that process to you too. But the most important thing, I think, the biggest takeaway to just get in the start of takeaways is the mortgage lender really is first, because it's just like saying, hey, I want to go on a road trip, and you don't have a map. If you don't have a map, where are you going? What are you doing? How are you going to get there? You don't know any of those things without having that map per se. And I think that you're really the first point on the map. Is you're the best place to start. Yeah. And that being said, I know we've kind of like round robined a couple of different topics, but to touch base back in on the refinancing piece, I think it's the same as making an original purchase. I think there's value in saying it's the same as the original purchase. It's the same as, just trying to find out where you're going, getting that starting point. So people will say, I want to buy a home, I want to refinance, and I don't know what the amount is that I should do. You're really the first step in that, and you can tell them based on what you have information-wise, this is what I think you need to do. So knowledge is power. It's why we're doing this. I think the 203K loan or the home equity, I wouldn't call it a home equity line because
home style. You're talking about
no. You don't do like the home equity line. Somebody's like, oh, I want to fix up my house and I want to, add these, awesome new cabinets.
Renovations
so I think everyone thinks, well, I got to do, an equity line of credit, and not necessarily is that the best choice each time, right? I mean, there's opportunities where that's, in fact, one of the worst choices they could make. So sometimes a cash out and refinance could be beneficial.
Well, there's cash out, which is going to cause your interest rate to go up a little bit, but then you're kind of just using your money however you want to. There is the equity line. Sometimes equity line is the right way to go. We don't do equity lines of credit, but if that's the best option for you, or to go out and get a second from a credit union or a local bank, I'm gonna tell you, hey, for me, I'd go talk to the credit union and pull out an equity line or a second on this. For a lot of folks, a great way, if they're doing pretty substantial renovations, is to do a renovation refinance. So what you're doing is you're going to capitalize on that extension or that renovation at the refinance table. So you can do $50,000 of renovations, let's say, on a $250,000 home, and today maybe you owe $240,000. Well, you can borrow, potentially up to $300,000 or a baseline of $300,000 minus whatever equity is required for the loan product today. So you can have all of that financed into your existing primary first mortgage with an FHA 203K or we have a Fannie Mae version of that. It's a home style. It's a conventional loan. It's a little bit more liberal about the things you can do. You can have a swimming pool. You can do all sorts of luxury items, they say, with the home style loan. So whether it's a purchase of a home that maybe is an as-is home that you can get dirt cheap because nobody else can buy it because they can't get a loan for it because it says cash only. Well, maybe we can turn that cash only home into a renovation purchase. And now you're in a pool of buyers, and so you got a much better chance of getting a great deal on the purchase. Or the other good place for the renovation loans is that person who wants to do renovations to their current home, and they don't want to go out and do an equity line, they don't want to run up the credit cards, will just increase the size of your first mortgage and get paid the money up front. Let a contractor draw that money out, and 3-4 months from now you got everything you need. So I've done refinance loans for folks, renovation refinance loans, and their mortgage payment didn't go up from where they were at because there was a substantial difference in the interest rate. So they save on the interest rate. Maybe they've been paying for 7 or 8, 10 years. So they have some term in it. So now they've stretched out where they're at 20 years left. Now they're at 30 years, and their interest rate went down. So their payment went down, and they added a whole, renovation to their room, to their house.
So I think another thing, and I'm going to change gears a little bit here,
sure.
but still relevant. I think
sexy sax man.
That was what I was doing. Yeah, because Christy. Of course, my wife thinks that. She'd probably be the only one.
You didn't have to say it was your wife.
Well, yeah, I mean,
it's all those people out there saying
exactly. I think there's some value in also talking about the rental market versus the purchase market. As a realtor, and I see there's a couple of realtors that have, joined in to watch. I think we can all agree that rental market is really just as expensive as a purchase market would be in a month-to-month scenario.
Sometimes more expensive.
In a lot of cases, it's actually more expensive. But I think it's also valid to point out that while that rental market is, in most cases, more expensive, it's also important to say, I think it's important to say that you might not have the credit to buy a home, or you might say, well, I don't have the credit to buy a home. The answer is, if you can get qualified, most cases, if you can get qualified on your credit to rent somewhere, then you will probably be able to get a loan for a mortgage. And I think that the reason is this. In a rental scenario, you can just skip bail, as it were, and just leave. And, if you've got bad rental history, that's why they're a little more strict. The mortgage lender is going to look at this as more of we actually have a tangible asset, or well, not the mortgage industry, the bank, the lender is going to say, we have a tangible asset we could take back if these people do in fact crap the bed and don't pay their stuff. We can go back and get the asset, and we can at least at a minimum sell it and make some of our money back. Yeah. Whereas an apartment complex, if you just said skip rent and bounce on off to the great beyond, they've got really no recourse to get the money back. So what are your thoughts about rent versus own in that regard?
So part of this is just personal experience and what I've seen with myself and other people. It's the person renting the home or the property gets to determine what they ask you. And so it could be, you're renting from your sister's brothers or, your sister's neighbor, whatever. And they're like, hey, sign this piece of paper, you're good to go. A lot of times it's not that easy, right? No, most of the time, they're like you said, they're concerned. So they can come up with all sorts of crazy things. They ask you, to set up a rental arrangement. The mortgage industry is regulated. So we're going to ask you for what we're required to ask you for. We're going to try really hard not to ask you for more than that. But you can pretty much go online or anywhere and figure out this is the sort of stuff you're going to need to present in order to do a mortgage. We talked about some of those items a little while ago. It's oftentimes it can be an easier process, I think, to do a mortgage application and secure a mortgage than a rental. I don't think it's necessarily that way. All the times, obviously, the circumstances around the rental are going to vary. I think hopefully people that experience our process and our Easy app, I had a guy that did one the other day. He did it in about 25 minutes. I had all of his information and all the documents that I needed. I think I needed 1 or 2 things more from him. He did it in 25 minutes. He was done. I pulled the Easy app into our system, reviewed all of his information, sent it to our underwriter. The next day, he's approved for loan, underwritten, qualified. So that is where the 6-hour underwriting process actually occurred.
Really,
He had it in day one. We had him approved on day 2. So approved for a home purchase in a day, essentially. Now are we done in a day? No. Now we got to go get title. We got to get an appraisal. You have to get an inspection. So there's a lot of things that other people have to do to get ready for the transaction, and the law requires a certain amount of days between contract and close. But the process can be very, very simple, and it depends. If you're a self-employed person and you own 15 rental properties, it's not going to be that simple. Okay, we're going to spend a few days getting your documents and stuff together. But if you're a basic W-2 employee, like most of us are, we can probably get you in and out.
That I think is fair.
Yeah.
On the other essence of investors, a lot of investors that I get come up with the same questions of like, well, I've got cash on hand. I'm gonna spend my cash on this property. I've got $100,000. I'm just gonna buy the property outright. And while I can appreciate what they're trying to do there, maybe you can speak a little bit to the danger of taking every asset you have and dumping it into one bucket. What are your thoughts there?
Typically, I'm not a financial advisor, right? So my disclosure statement up front is going to be, hey, do you have a financial advisor? Have you talked to them about that strategy? Because from my perspective, you got a total of $500,000 in assets. You're going to buy $400,000 a home. You're just putting, 4/5 of your investment into real estate.
Mm-hmm.
Most financial advisors are not going to tell you to do that, to invest that heavily in any commodity, let alone real estate. So for an investor, you should look at a purchase of a home just like any other portfolio item, or the portfolio is where you put your money, different, where you invest your money. It might be in stocks, it might be in bonds, it might be in mutual funds, it might be whatever the case may be. You diversify, right? That's what the financial advisors tell you. I'm not a financial advisor. But what Pete Griffin thinks is if an investor's coming and he's putting an unreasonable chunk of his money for a cash purchase, that doesn't make sense to me a lot of times. It may make more sense to do a mortgage so that they're not tying up all their money in real estate. If they got gazillion dollars and it's only 1% of their investment,
if they've got gazillion dollars, then they probably buying $100,000 house. But
right. Well, but it may make sense for them to do a cash purchase. Sometimes it makes sense, and that's the right answer. Oftentimes, people decide to do a cash purchase, and most financial advisors would tell them, "Why are you doing that? There's a lot of leverages and benefits to having a mortgage. There's things that can help you with your tax disposition. It's possible that it can take somebody and change their tax bracket because they have interest that they can write off on the mortgage, and it's feasible that they could save substantially on their tax burden by having that additional write-off of the interest that they're paying."
And I really think that's actually a good point to throw out also, just because, like I said, if you're just joining us, we've been talking about mortgages and what the value of owning a home is versus renting a home recently. That's probably one of the biggest, to me, it's one of the biggest financial benefits is when you own a home, you are able to write off a portion of that home. It's an asset that you're able to depreciate or appreciate over time, or however you want to look at it. But when you're doing your taxes, and again, we're not tax benefit advisors, so we're not telling you how to do your taxes, but you can write off what is it they're writing off? Their mortgage interest, correct?
UF mortgage interest.
So you're writing that off. So already you're ahead of the game because A, you're not paying somebody else's mortgage when they rent the property out, because that's what they're doing. And then number two, you're able to actually write that off for yourself. I think that there's a lot to be said.
And again, it depends on the individual. You do it, I do it. Can everybody do it? I don't know. I'm not a tax professional. I don't know every income bracket out there. But the way I understand it, most people are going to enjoy an interest write-off. And even the conservative advisors, I like listening to Dave Ramsey sometime, and I think if you're a conservative investor, even his advice is 25% down, 15-year fixed rate mortgage. And so that's a good place and good advice from somebody that tends to err on the conservative side of financial planning. Obviously, if you can have no debt, that's great. It's a good thing. It's definitely bragging rights. But if you're having no debt is a investment decision, you just got to look at that. where are your priorities? What are your own personal goals? If you're that, passionate about never having debt, then that's your goal. And I'll tell you, hey, don't get a mortgage. It seems like you're really driven by this ethical desire to not owe anybody money. Maybe a mortgage isn't the right thing for you. But if you're looking at it strictly from a financial planning perspective, it may make more sense to have a mortgage by paying 100% for a house.
So I get a lot of military families, right? That's one of they're near and dear to our hearts.
I'm gonna get a little bit more of this.
Okay.
Keep going.
It must be his favorite song or something, I guess.
Yeah. Sounds good.
Okay.
Just don't start playing air sax again.
Exactly. Well, it depends. This is more trumpet, by the way. I just want to throw that out there.
Well, I'm no trumpet.
I think it's valuable to bring up the point that a lot of military families, they come to the area, and our area is great for this. They buy a house, and then no sooner do they buy their house, they get orders.
See, look, we're getting all sorts of thumbs up because we turned the jazz up. So
I'm sure. I'm sure it's got everything to do with the jazz.
Nothing to do with the advice.
It's got nothing to do with, let's see, it's got nothing to do with Julie White or Kenny Jones, who's military, getting on here. I have anything to say about it, right?
Yeah, all right. Well,
Lieutenant Colonel Jones, thank you for joining. I just threw that out there real quick. I think there's a lot of value in putting up, right up front. They buy these houses, they get locked into an interest rate, then they get orders to Okinawa or to, God forbid, like a place like, Minot, North Dakota for my Air Force folks, or even worse, they go to like Fort Bliss. I think
there's people that love these places.
I don't think they're on. My wife is from Texas, and she would agree that she doesn't like Fort Bliss, but that's neither here nor there. If you like brown dirt, like Fort Huachuca's the place for you. Anyway, all that being said, they buy these houses, they get in these interest rates, and then they're like, okay, you know what, we got orders to move. What then is the best thing for them to do in order to protect their investment? They're going to rent the house out because they can't afford to sell it, or they bought the house because it's an investment and they want to do something with it. What loan products are best for renting homes out? If I've got an investment, let me put it this way. I bought a home. I've had it for 4 years. I just got my orders to go to, wherever. And now I'm going to have to put my house on the market to rent it. When I got it, the initial interest rate was whatever. What should they do? Should they even consult you and say, hey, look, I'm possibly going to have to rent this out, possibly being the key word?
Yeah, I think it's a good question, because there's been cases where folks, my former colleagues from the Marine Corps, or even just folks that I met in the local area that have that same situation. Sometimes it's best to keep the loan that they're in and rent it out with where they're at. Sometimes it's best to refinance to a different loan product. For example, so we got to have the whole picture. It's like anything, I get the whole picture. But say, for example, they have a $200,000 home here. They've got some promotions or raises or whatever. They got out of the military and they got this nice job with their military retirement. They're going to go buy a $500,000 home somewhere else, in, let's say, Northern Virginia. It may make sense to convert that $200,000 VA loan that they had over to a conventional product. Maybe they got 20% equity in the home, convert it over to a conventional loan with a refinance, so they free up all of their VA eligibility to go north and buy that $625,000 or less, Northern Virginia VA eligible high balance loan.
Absolutely.
So you got to look at both sides. Where are you going to be in the next home, particularly the veteran? It may make sense for him to free up his VA. Now, if he's buying a $250,000 home in Northern Virginia and he owns a $200,000 home in Fredericksburg, he's probably going to still be able to use his VA.
Sorry, I'm putting myself back online on YouTube. I lost my home to foreclose or something, and I lost some of my eligibility.
Yeah.
What can they do to get some of that eligibility back? What can they do to regain? I mean, is it completely gone and lost? They should just hang up the phone and say it's all done, or should they look to see if there's something else they can do to regain that? I mean, is there an avenue that they can go down? Is it legal or what?
So we had, I think we had together had a buyer who was told by another lender, "Hey, your VA eligibility, you lost your VA eligibility because you had a short sale," and that was only half of the answer. You don't lose. You can lose all of your VA eligibility, but in this particular case, he lost a portion of his VA eligibility, and so there's a thing called a what is it called? VA second tier or VA eligibility second tier. I don't know. We have a worksheet, right? I can't remember the name of the worksheet.
Call for the worksheet.
It's my worksheet, not yours, right? So
call him. He'll take care of it.
I'm gonna take a look at how much eligibility that's still available on your certificate of eligibility. It's going to say how much you've lost, and it's going to calculate how much you can still purchase on a VA loan today. So in this particular gentleman's case, it turned out that he could still buy a new home on a VA. He had to bring a little bit of money to the table, but it was still better than an FHA 3.5% down. Still better than a 5% conventional loan. He just had to bring a little bit of money to cover the gap between what his VA eligibility was for and what he was purchasing the house for. And that's true, actually, for any veteran if you're buying over the VA loan limit. So the VA loan limit is a loan limit, not a purchase limit. So if the VA loan limit in your area, let's say King George, is $417, and you want to buy a $500,000 home on a VA, you can do that.
Sure.
You just got to you got to protect the portion of that loan that the VA is not covering. So you're bringing 25% of the difference between what school you're qualified for and what your purchase price is, or what the limit is and what your purchase price is. More than you asked for on that one. Sorry.
No, it's good. So there again, I think there's a lot of value in the information that you're putting out. Of course, I'm going to think that because you're my number one guy. Not like Jack Nicholson was the number one guy for Boss Grissom, but more to the effect of, I just know how much you care about people, and I know how much you treat this job with, I will call it respect. I think that, and we're getting ready to wrap up here as far as all that's concerned, but I think.
Is that what Debbie was calling you?
Maybe, who knows? I got an interruption there, but it's all good. We'll get back to you. I think there's value in putting it out there that, refinancing needs. People might not know what their refinance capability is. If you don't know, you need to call. People might want to buy a house and not think that they can afford it. My Richmond voice came out there. I almost called it a house instead of a house. You might not know what you're able to do. You need to call. So what's a good phone number and contact information for you?
So the best thing to do is to call me at 540-834-8826. A great way to get me also is through my website.
I'll link all that.
I'll give you a link to the website. Okay,
yeah.
Great.
Email address?
Email address is no, that's a website. Pete.griffin@movement.com is my email address. Pete.griffin@movement.com. And these days with social media and the electronic technology, the easiest way to do an application and get things started is my website. You don't even have to call me. Go on my website, start an application, put everything in, and I'm going to call you, and we're going to talk about all your circumstances. You may not be able to know all the things on the application, which way to go. Give us a starting point. You give us something to talk about. So,
just like Bonnie Raitt.
Yeah,
you're giving them something to talk
about. I want to talk to you. I want to hear what your case is, but you enable me to be more prepared for that conversation by filling out an application online.
Debbie, if you're watching, stop calling because you're messing my iPad up. That's what we're broadcasting on. Okay, last but not least, certainly. Pete, thank you so much for your time. Again, if you have any questions regarding purchase capability or what should you do, and you have any kind of mortgage questions, Pete, I would even go as far to say is you'd be willing just to discuss the mortgage process with somebody who has any other random outstanding questions. That's a fair statement?
Yeah, I'm happy to talk mortgages with anybody, any day, anytime.
All right.
And I always tell folks you need to pick a lender who you're comfortable with, It may not be me.